building connections to achieve growth. That's what you've brought us in today, and that's what we're here to help you do. Hi, I'm Spencer, and with me are my colleagues, Jordan and Stuart, and we're here to help you assess a viable opportunity to expand into a new market to achieve excellence for your customers. We have a brief agenda of what we'll be going through today. I'll be beginning with the problem identification. So, first up, should you enter the Japanese market? It's different, it's volatile, and there's been tremendous change in the past few years. Second, how should you achieve this strategy? Should you buy an existing firm? Should you start your own firm? How would you go about doing this? With these two options, there are some secondary issues. Cultural issues, very big difference between the markets you're currently operating in and Japan. Second, cost. There are some very different costs associated with these two alternatives. And finally, human capital. How will you be transferring your current human capital into the existing capital that's already out there, depending on which option you're choosing? So I'll now pass it off to Stuart with an analysis.
Awesome. Thank you very much. Okay, so I just want to go a little bit into a high-level qualitative analysis to give a brief overview of what we're going to be talking about. So when evaluating your firm, we're very happy to see how developed you are and how open to growth you want to be. And we've looked into your value investment strategy and where you've come from. And so we want to really stay strong in that viewpoint. But looking at the Japanese economy, we saw a couple strengths that the economy's had. So consumer investment growth. There's a high level of consumer investment and a lot of opportunity for growth in that sector, and we see that as potential strength going forward. Weakness, as Spencer kind of addressed in the opening of our meeting, volatility. This is something we must address if you do want to get involved in that sector, and there's a lot of risk inherent there. Some opportunities, so diversification of your global portfolio. Right now you are involved in a lot of international markets, and as sectored out of Vancouver, you are involved in a nice hub on the side of North America there. And getting involved in Japan would be a really nice addition to your global portfolio. So we see that as a really nice opportunity. And threats, they're kind of the normal threats for finance. Currency risk, monetary policy risk, and some international regulations that we want to go through. So we just formed a little bit more of a lower level political economic kind of overview. So for political, we just went through some foreign economic things. Global environment was one of the major keys that we tuned into, because going into Japan, it is a global marketplace. It is trading in an entirely new market, and this is something we need to really concentrate on. For economic, competing firms. There's 250 competing firms offering similar services that you are currently, and this is something that we really want you to factor into your final decision today. Societal differences. North America and where your primary markets are, even Bermuda where you're headquartered out of, will have completely different cultural impacts than where you are moving into in Japan. So something really to think through. And just heading over to environmental, there might be some cultural shock heading into a totally different market. So just a couple of things that we want to have in the back of your head as we're heading into this meeting. I'm just going to pass it over to Jordan to go through some of the financial assumptions we made going forward in our financials.
Thank you, Stuart. So, looking into the assumptions, given the currency on the date we analyzed this, it was currently 100 Japanese yen for $1.80 Canadian. Looking at that as well, we factored the cost of capital on the industry benchmark. So in any independent project you're valuing, you would want to use the independent industry opportunity cost you could elsewise other get, separate from your corporate entity structure. So along with this, looking at the different models we use a 40% growth rate for earnings. This comes from the very high trend of growth and the very high cyclical cycle we're in right now in Japan. The annual average growth the past 5 years was 40% on the top line as well as the bottom line. Now, looking at the perpetual basis, the long-run average, we see something kind of considerably lower. Since Japan kind of fumbled with the stimulus packages and different monetary moves from 1990 onwards, we've seen an approximation of 5 to 10% average. We would go with the lower end just to be more conservative. Looking into our first analysis, what we did is we took on the approach that you're going to start a new firm, get in there, go through the regulatory proceedings, pay all the upfront costs, build your business and start from the ground up. We use the cash flow and net present value approach in doing this because we can evaluate specifically the cash flows at different years. Now in the cost side, we looked at the startup costs, the regulatory costs, and the associated permits with the Japan Mutual Dealers Association that you told us about. In this as well, we use the Target Co. company as a relative competitive benchmark. It is appropriate because it's approximately the size of the company you want to start out on in Japan. And because we're not at that quite level yet, we've given ourselves a little bit of a premium by using 80% of their current costs and revenues as our current starting point. We believe once we get in and we establish the current permits in a regulatory process, your benchmarking, your diligence, and your long-term historical track record in global markets will take over, and this will flourish. So in doing so, on the 5-year time frame, this is the intended time target you've given us to kind of make a decision for you. We've analyzed a $7 million Canadian net present value. This is taken into account for currency already. So on the high end of sides, we're going to drive in about 20 million revenue in the first 5 years on the Canadian side from the current management fee structure that Target has. And on the cost side, with the building initial costs and operating costs going forward, is that mark there. Looking on the analysis of taking on a firm, buying a firm, getting the market, getting that established firm, we've used the PE growth model. Now, how this works is essentially we've valued the model on earnings. So we've taken in the current earnings of Target Co. currently in the year you want to buy it. We've grown it at our 40% rate for the annuity term of 5 years. We've essentially discounted this back and used our average PE metric to come up with the $10.9 million value. As you see, market cap 592, and then it jumps down to 10.9. That's just taken into account for currency. So as you see, your company is growing with these growth rates throughout the 5 years, and then we're bringing it back to time zero. Yeah. And this is all based on the conservative PE that you currently have right now. So I'll hand it off to Spencer to talk about the discounted cash flow model and the multiples approach.
Thank you, Jordan. So looking at the free cash flow from Target, which you had brought forward to us as the opportunity you would like to explore when you go into Japan, we looked at the next 5 years for their free cash flow using that 40% growth model that was mentioned earlier, and then to grow it perpetually to figure out for the future lifetime of the company, we used that 5% conservative growth rate that we had mentioned earlier. Using this, discounting back to the current time, we found it to be approximately $11.5 million Canadian, and that was with those two considerations that I had mentioned. Using the multiples approach of the price to book, price to earnings ratios given in the industry, we took an industry high and an industry low looking at Target's current earnings and market cap, and we found in Canadian that their current as it is today, without looking into the future, it's approximately on the high end $4 million Canadian and the low end $2.3 million. This is based on the industry average of how the competitors are competing and how they're performing in relation to how Target is producing in that market. So, going forward, we have identified 3 different alternatives, which we'll get into momentarily. First up is the Monopoly Man. Second is setting up shop, and the third is the DORA option. So I will hand it off to Jordan to get into the Monopoly Man option.
Thank you, Spencer. So, looking at the Monopoly Man, what does the Monopoly Man do? He goes into markets, he buys property, he builds up, he expands. This is one opportunity we've identified for you guys to address. What this will give you is established presence in the market. You get that key management who've been working there years and years, know what they're doing, know the markets they're operating in. You have the human capital in place. You have diligent, die-hard, already established employees who have worked there for quite some time and are comfortable with where they're at. Will make the best decisions for you in management interest. Also, you have the cultural awareness component built in. You're entering an established business with a workforce that lives there, operates there, plays there, and knows the environment better than anybody else, right? But better than anybody from the outside going in. And with this, gives you the enhanced market opportunity of getting into another place, getting a new firm, establishing in this direction, and continuing on with what you've been doing for a long time. On the cons, we know that there's always a premium. The premium you're paying for it was clearly addressed. This is what it'll be. So as you pay a premium purchase price, that is built in for all the components listed and is essentially supposed to return you value over the years, which we'll get to as well. Control. Part of your philosophies. You guys love control. You guys love to align your goals with each business you operate in. this is a major issue. You're already entering an established business, established framework, established culture. There's going to be some culture shock issues. You have to look at these as well. And the cultural differences. There needs to be a core strategy entering this company for communication and change management with the current culture. On the risk side, you could see your employees go. You know, a lot of jurisdictions you go into, employees operating under the domestic banner, working with current management they know, they've been there for a long time. Seeing them kind of decimate or take a different avenue is a huge blow to employee morale, and it increases uncertainty. This could have an adverse effect by your employees leaving you. As well, regulatory hurdles. We're just sweeping in foreign direct investment, buying a firm. What's the Japanese government going to think? Are they going to allow it? Are they going to like it? Are they going to work with us? Huge key to consider. As well, market perceptions. We're coming in, brand new foreign company owning this company that's been established, that's been doing well. What are your competitors going to think about it? What are your employees going to think about it? All the stakeholders together evaluate these options when they're doing business. It's a key issue you'll have to address. I'll now hand it off to Stuart to talk about setting up shop.
Thanks, Jordan. So with setting up shop, it's really important that you think about the investment philosophies that we've talked about for us considers. Control, independence, and long-term viability. So this would be to start up your own firm in Japan, to be independent and have complete control, calculated risks. So you'd be able to go in on your own timeline, be independent, and be essentially your own contractor in there. Again, this would be organizational cohesion. As a very strong pro, you'd be able to come in, have top-down management of your own hand-selected personnel, and move in and have a strong organizational mandate similar to what you have in your pre-existing markets. There are some cons to this, however. High-level risk. Of all the options we're going to present today, this is the highest level of risk, as you have previously low-level experience in the Japanese market and low-level exposure in your previous investments. So, we are proposing that you're taking pre-existing British pounded securities into the Japanese market, so these may not be accepted. Again, lack of human capital. Your organization may not have experienced HR professionals to hire Japanese professionals. You may want to bring in, and as Jordan addressed earlier, the Japanese securities laws allow a timeline for 1 year to achieve that designation, and it is a bit of a struggle to move pre-existing experience into Japan. So that lack of human capital that's already in the organization is a bit of a con. So again, lack of local knowledge, time, and regulation. So the regulation goes again with that Securities Commission that's pre-existing in Japan. Time is always on the side against someone who's coming into a pre-existing organization. So when you're coming in trying to be the new kid on the block, set up your own shop, it'll go against you. You do have strong institutional values and core values that you're bringing in, but this will work against you as there are a lot of competing subsidiaries already there. So some risks that we're going to have to work against. Regulatory battle. Japan is highly regulated, and this will work against you. Consumer perception. As Jordan kind of addressed already, you are coming in as a large dominating firm, but if you don't work with the Japanese, they may work against you and kind of bulk up against the big kid coming in. Monetary policy and currency risk. The yen is strong right now, but may work against, and if you aren't working with Japanese firms and working with the Japanese government, this may hedge against you in the future. And again, currency risk, this is inherent in most decisions, and you just have to hedge properly, and we're going to talk about some strategies going forward. I'm going to pass it off to Spencer to talk about our third option.
So our last and third option is the door option. So it's out there to explore different markets. Look for a different opportunity in another area of the world and see if there's somewhere we can enter with less risk. So with this, there are pros. You could go to a different market that has more sustainable growth and less volatility. You can capitalize on current trends, and it will also help you, again, diversify, which is what you are looking for in the Japanese market. Some cons, you're back to square one. You've done a lot of work at already looking into Target, you've compiled their data, and this has been the option that you've been looking for. And with that, already back at square one, there are sunk costs, and looking at the option that we will go with, you'll be missing out on a huge opportunity cost. So again with this, just like the last option, looking into other global markets, there are always global uncertainty with different markets, currency risk and interest rate risk. It doesn't matter where you go, those exist. in every market. So those risks remain, and now I'll pass it off to Jordan to get into a little more of the organizational history.
Thanks, Spencer. As your independent consultant, we've had the opportunity to take a holistic view of your goals, your ethics, your integrity, and what you stand for. What we've come up with is that you're a big player in the long-term capital appreciation business. This does not come with alignment of interests. It does not come with individual accountability, and it does not come with sustainability. Looking at these going forward, we've taken advantage of a number of global opportunities available to yourself with your resources, your organizational capacity, and your human capital in place. What we would do is we'd enter the Japanese market. We would apply and incorporate a special purpose entity, which is essentially a holdings company, to separate your assets, your equity, and most important, mitigate your risks and segregate that. In doing so, we would have zero external liability outside Japan from your initial company. And looking at that, we would purchase the existing company, as we believe getting that key set-up company in the market with the growth opportunities available is your fastest approach. You've already spent a number of months analyzing this and doing your due diligence. It's not time to go ahead and build another ship. It's time to jump on the ship. With that, the range of values we've looked at and the models we've assessed, we've taken the average of $8.2 million takeover price. Now, there is a range of values you can negotiate with, but this would be the recommended buy. With that, you'd set up a mandatory dividend reinvestment plan. What this would do is essentially capitalize all the dividends coming through in your balanced portfolio and your global equity portfolio, and it would position it in a long-term compounded scenario. And because of the essential tax-free savings account in Japan at the moment, this would be highly beneficial to consumers, as they would be taking tax-free income, rolling it over into new shares, and compounding substantial growth going forward. This is what's going to separate you from the companies in Japan. As well, company fee structure. You are big believers in your current differentiated strategy. This has never been done in Japan. How do we do that? We are going to seek a gradual change from the current model to your new model. This will be shown in the implementation. As well, risk. You're entering a new market. You have currency uncertainty. You have monetary policy uncertainty, interest rates. Japan's been playing around with stimulus for years. What are they going to do next? We would suggest taking a small portion of your portfolio and purchasing a put option in Canadian funds. What this would do is protect yourself from Japanese downside. So in the event that the Japanese market crashed and your assets went to zero in Japan, your organization would be safe, as you would have a revolving 3-month option on the major index itself to capitalize on the downside potential. I'll now pass it off to Stuart to talk about the first 6 months.
Fantastic. So we just brought about a bit of a timeline to talk about how we would go about implementing the strategic recommendation. So within the first 0 to 6 months, this is essentially setting up, moving to Japan, moving your organization into Japan, and setting up the special purpose entity. So negotiate the purchase price of an organization anywhere between $8.2 to $11.4 million, as Jordan explained, and assemble a Japanese management team. This is essentially organizing the organizational structure that's going to be in place for the next 5 years of your firm, and this will be building the foundation that your company is going to stand on. It's the most important and key decision you're going to make, and it's going to set the tone for the next 5 years of your company. I'm going to pass it off to Jordan now to talk about the 6 to 2 years of the company.
Thank you, Stuart. So all the global opportunities available to us, as I explained, this will be the key time to set up the administration and identify what you have to do. So going forward, we begin our change management process, gradually breaking your new fee structure into the new company and roll forward with the management in place. We would seek to keep the management on place, act as a cross-cultural awareness intermediary, and roll forward with that plan as well. With this, we would set up the DRIP, pay some administration fees, set up. There will be regulatory filings with the Japanese government, as well as your own home country government, to administer this and make sure the taxation procedures are correct. All this would be identified. As well, we purchase the put option. We reassess the portfolio mix and get a option put in the portfolio as we identified. As well, this comes with a premium and transaction cost. This will be essentially part of your strategy. 2 to 5 years, we're going to reassess the position. We are going to explore market opportunities. Because the business already has an array of financial services, we are going to explore those opportunities at that mark. Risk mitigations, value perspective, risk adverse, capitalization of Japanese markets. You are going to expand the global reach and keep all these in mind. I'd now like to open the floor for questions. Thank you. Yeah.
So you mentioned changing the fee structure to our fee structure in the long term. So what's the initial fee structure? And if it's a regular fixed fee, how does that make this product any different from what's already out there?
So the current product of the company, or?
The current funds, yeah.
Yeah, so what you're doing is essentially a mix of things. You're bringing in your two UK funds, positioning them under the new banner, right? You would keep your existing business, block of business in your existing company setup, and you would roll over your new funds in this setup. We do believe, because of the potential upside with the hedging and value proposition in place with zero taxes,
Sorry,
hedging.
maybe that's my question.
Sure.
So you recommended moving to our fee model in the long term, but
Yes.
initially having some different fee. What is that different fee?
So essentially,
And if it's a fixed fee, how's that different?
yeah, so essentially right now in Japan, the current model, they're just running under AUM, so assets under management. They just take a fixed fee of assets under management per year, and that's it. So typically how they grow is they grow their block of business and they get capture more of that fee. And like I said, in the long run, your fee would be rolled over with your new products and reanalyzed at the current level to assess that. And with this, the market will see the value potential of what you're doing, and also a key differentiator to fight for.
You mentioned a purchase price, I believe, of 8.2 to something else. So if Target wanted more, what would you recommend to them?
Okay, so essentially, we accumulated the 8.4 through our different valuation models. With that, we're assessing that that includes the intrinsic value of that and all the capital assets that Target owns. If they're wanting to go more, we would reevaluate what the more encompasses essentially. If that's capital leasing, all the leasing contracts they may own, the capital of the assets they're bringing to the table, and reassess the model that we used. Because again, it didn't include it. A lot of it was done with a lot of assumptions for what capital assets they may own currently, and just some of the assets under management as well. So again, we'd be open to reassessing the model, but it was all done a lot with the intangibles that they may own.
You assumed an average growth rate, you said in your financial assumptions of 40%. Could you please justify that, link that to your qualitative assessment of this opportunity?
So what we did was we looked at Target's previous history in the historical data that you'd given us, and also looked at the market trend that Japan had demonstrated in the case that was provided. And with this, we used a weighted average and found that 40%. And with this, we believe that it was reflective of the current volatility and the current upward trend that Japan is experiencing, and that's why we use more of a conservative long-term growth rate for the perpetuity in the discount of the future funds.
The implementation plan slide, the 2 to 5 years, there's a line talking about underwrite / IPO.
Yeah.
Just expand on that?
Sure, so given your 5-year time frame and how you want to operate and expand into this business, the current business Target Co. has these financial services lines already in play. So focusing on your current existing business and your transformation into it, you can kind of keep this on hold and watch this for the time frame. At the 2 to 5 year mark, when you're established, everything's set up, you're full on board running, you can look at these lines of business they're already currently in. So currently they're in underwriting IPO, listing companies, selling, allotment options, that kind of work, as well as some other financial advisory services. This was a big factor in analyzing the potential of this company versus starting your own, because they're already in these lines of businesses.
I don't understand why monetary policy is a risk only when setting up new shop. Isn't monetary policy always a risk no matter which option I choose?
Yes and no. So with the setting up new shop, you would be going in full bore and you wouldn't have any downside protection with the options in place. With buying an existing firm, we would kind of hedge out our currency a little bit, and the fact that should monetary policy ever have the effect to go sideways, we would be protected on the downside.
Get out now.